Everybody must have, well, I assume people read the reports on President Xi's speech last night at the Boao Forum, where he talked about the 40th anniversary of Gaige Kaifang, reform and opening. When I think back 40 years, I think of when I was a small potato in the U.S. State Department, working on, in the legal advisor's office, working on the establishment of diplomatic relations with China. And I can tell you one thing with absolute certainty, that no one could have predicted that we would have a meeting in 2018 on Chinese investment in the United States and U.S. investment in China. It certainly was not in the minds of any of us who were working on the establishment of diplomatic relations. It is now, this investment has now become, especially at a time of difficulty in the relationship, an incredibly important part of the relationship. And in many ways, it's investment, as I've said in previous years, it's investment that serves as the ballast in the relationship, because investment, as opposed to trade, creates what I call a permanent relationship. In trade, you sell your goods and you go home. In investment, you're married. You work to make the investment work. And it builds, as a result of that, a people-to-people bond, which makes the work for us at the National Committee on U.S. China Relations easier. This year is slightly different from what we've done in previous years. One is we have combined our two reports. We've combined the rollout of the two reports. One is the two-way street, which we formerly did separately from our new neighbors. New neighbors is, of course, a focus on the economic impact of Chinese investment in the United States per congressional district. And two-way street is a focus on Chinese investment in the United States and United States investment in China, and a comparative look at what's going on. Dan and Thilo have warned me not to spill the data before they take the stage. So let me just close by thanking our sponsors for this, because this is not a minor undertaking. You know, I won't be giving away the data, Thilo, by saying there are thousands of Chinese investments in the United States and U.S. investments in China. And to gather that data is a major, major undertaking. So I thank the American Chamber of Commerce in Shanghai, who's represented here today by Ken Jarrett, for being a sponsor, and also the Chinese General Chamber of Commerce. We have chambers on both sides of the Pacific that sponsor this. And I thank Chubb, Perfect World in the United States, and the Star Foundation for supporting New Neighbors. Because without this support, we wouldn't be able to do the programs that we do and create this incredibly valuable data. Last but certainly not least, let me thank Covington and Burling for not only giving us use of this fabulous facility, but for giving us this sunny day. I knew Covington's value, you know, but this is quite something. But thank you all for coming. It's incredibly important that you're all here to learn about this data. Thank you all.
Eric, thank you very much as you walk out. David, thank you very much. I'm Dan Rosen, a partner of the Rhodium Group, and it's my great pleasure to be with you here this morning with my colleague Thilo and our partners, Steve and others from the National Committee. 3 years ago, Thilo and I started this U.S. China foreign direct investment project in partnership with the National Committee, and this is the third annual cycle of updating this pair of reports that we're here to release today. I think it's fair to say we did anticipate how important the foreign direct investment channel of the U.S.-China relationship would be, and the role that these two-way flows of investment and commerce would play in shaping the next era in the relationship, making it a deeper, richer, bigger, more complicated relationship beyond the time in which China was just a recipient of global firms able to operate outside their own borders, but instead brought us into the era where we were more peer competitors. Two large nations and economies both able to contemplate their firms operating far from home in new ways. Our goal in starting the project, undertaking the research, was to ensure that the discussion of this complicated new topic, this new channel in our relationship with China, which, by the way, is a new aspect of the relationship with China for everyone in the advanced economy world and in the developing world as well. It's not all about us. It's a global phenomenon. But to ensure that that discussion would be conducted based to the greatest extent possible on objective data and observation about what was actually happening, not just based on fears, hopes, conjectures, and data which might not actually be the right data with which to describe and take stock of what was happening. When we started this work well over a decade now, back in the mid-2000s, when it was not even tomorrow's issue, but the day after tomorrow, it didn't seem as though there was really any growth in Chinese outbound investment because people into the United States, because we were still relying entirely on balance of payments methodologies, as Thilo is going to review and go through the numbers in just a second. And it just wasn't telling an accurate story about what China Inc. was ready to undertake here inside the United States. And so we set out to make sure this wasn't going to be the best we could do in terms of the quality of our public discussion. In this third of a 3-year annual undertaking to do this report, we've now gone over these 3 years from the initial contribution, which was just setting a baseline of understanding for what was happening across the breadth of the two-way flows and down in the depth of Chinese presence here in the U.S. down to the congressional district level. From that initial baseline, just to have a foundation from which to discuss this together as we're doing here today, to year 2, which was all about the upside. We had an extraordinary takeoff in Chinese outbound presence here in the U.S. And as you'll hear just in a second, now we're applying the same methodology approach to analyzing the issue to a time of some downtick in the activity taking place between our two economies. Whatever the direction of these trends, in both directions, we think we're continuing to make a contribution by making the discussion more objective. It's all the more important today at a moment when it sometimes seems like everything is fake and nothing is credible, and there's really no solid base, not made of sand, under any of the critical public policy issues we have to tackle as responsible citizens of our various countries. It's good to imagine that it might be possible, it might just be possible, to return to objectivity as a way of making better policy choices and decisions. And with that, let me ask my colleague Thilo to come up and walk us through Two-Way Street and New Neighbors 2018 updates to our work. Thank you. And I'll be back after Thilo to offer a few forward-looking thoughts.
Thank you, Dan, and thank you all for coming today. Just got to figure out how to get this PowerPoint started. There we go. Okay. Here we are. Having objective numbers on two-way U.S. China FDI is not just important because we have a very emotionally charged political environment, but also because we have witnessed some pretty important deviations in two-way investment flows from past trends, which we think are indicative for the future. So I'm going to spend about 10 minutes to introduce you to the highlights of both reports that we released today, looking at U.S. China FDI in 2017. Behind me is the big picture view of 27 years of two-way U.S. China FDI flows. And zooming in on 2017, there's two things that are immediately apparent. The first thing is that we're seeing a big drop of Chinese FDI in the United States, which declined about 35% from the 2016 figures of from $46 billion to about $29 billion. And the second, well, maybe not so apparent pattern is that U.S. FDI into China remained pretty much flat, which sounds boring, but given all the talk about China opening up and had a big presidential trip announcing a lot of deals, hundreds of billions of dollars of deals, that's a surprise. It was a surprise to me, at the least, that we don't see an increase in U.S. investment into China. So I want to start with U.S. FDI in China, taking a closer look at what happened last year. Again, these are the patterns over the last 27 years. As we can see, U.S. FDI into China increased steadily up to a peak of about $20 billion in 2008. Then we had a bit of a dip related to the global financial crisis. Pretty quickly, things rebounded up to about 15, 16 billion in 2010-11. But ever since, so for the last 5 or 6 years, we've been pretty much flat at about $14 billion per year. And the majority of that was Greenfield FDI, so building new facilities from scratch. M&A has stayed at about a third, about a quarter of the total for the last 5 years. Cumulatively, we have now about 7,500 individual transactions in our database that are worth almost $260 billion at historical value. So if you were to account for depreciation, appreciation, in terms of total asset size at market value, we would be significantly higher today. So take 260 as a baseline and then adjust it upwards in terms of how much U.S. FDI stock there is in China. Now, why is investment flat? Why is there a lack of enthusiasm on behalf of U.S. companies to further increase their presence in China more quickly? And we're going to talk about that with Ken and others on the panel. But there's certainly commercial reasons for that. There's a slowdown in growth. There is a saturation in certain areas. And there is a big overcapacity in many manufacturing sectors in China. But then we also have to look at policy. I think a big assumption was that China is going to very aggressively move forward in terms of their economic reform process more broadly, but then also very narrowly opening up further to foreign direct investment in terms of sectors that are currently restricted with equity caps and other measures, and that we're going to see a more level playing field for foreign companies in China. The Chinese government has taken quite a few steps over the last couple of years to actually change things, and this is a formal indicator that measures openness in terms of equity restrictions and other formal measures. And as we see, things have been pretty flat from 2005-06 all the way up to 2013-14, but over the last 1 or 2 years, we've seen some pro forma progress in terms of opening up additional sectors. Most recently, electric vehicle manufacturing, things like that. At the same time, additional restrictions have been added, and if we look at surveys and our investment figures, we actually don't really see that activity is picking up much in some of these sectors that are most interesting for U.S. companies. This is a chart that shows U.S. FDI in China by industry. On the horizontal axis, there's total investment value, which is also the bubble size. And then on the vertical axis, we have the growth or decline in 2017. 3 things are apparent. First, we have a declining momentum in traditional sectors like electronics. We have strong momentum in unpenetrated consumer sectors. The 2 things that stick out are entertainment, which is not media and entertainment in a classical sense, but it's mostly theme parks that a lot of US companies are building out for Chinese middle class. And the second thing is food. And one big deal, of course, last year was that Starbucks was buying out its joint venture partners in Eastern China. So we're seeing U.S. companies still very interested in building out those unpenetrated areas of Chinese consumption growth. The second big area of growth, if you look at the top right quadrant, is sectors in which there are either commercial or industrial policy induced incentives for localization. So you have strong growth in ICT, where China requires some localization of cloud computing, hardware, and those kind of things. And you also have a strong growth in the auto sector, where we have policies in place that promote electric mobility with local content. But what you don't see is a lot of momentum in areas that the US is hoping to get some more market access. Healthcare is one example, and the other one that, of course, sticks out is financial sector, where we have seen some announcements, but not really a translation into additional investment, at least in 2017. Moving over to Chinese FDI in the United States, this is the same chart, 27 years of Chinese FDI into the US, almost nothing until 2008, 2009, with one exception in 2005, which was the first IBM Lenovo transaction, and then strong growth momentum since 2010, all the way up to the $46 billion that we saw in 2016. A big difference is that the majority, about 90% of Chinese capital coming into the US comes in the form of M&A as opposed to greenfield investments. In total, we count about $140 billion worth of Chinese FDI transactions in the United States. I already said we saw a 35% drop in 2017, but that's really only half the story, because what we count here in our report, we only look at completed transactions. So acquisitions that have been closed and greenfield investments that have been begun or have been built. If you look at that, it's only a 35% drop. If you actually look at newly announced transaction value, so deals that were announced in the course of 2017, the drop was more like 90% in value terms. So a pretty dramatic slowdown in Chinese FDI activity in the United States. So what's behind this drop? And I'm going to spend a little more time, because I'm assuming that's of big interest to this audience here. What's behind this drop is what we call a double policy punch. So policy has shifted both in China and the US, and that really has impacted new Chinese deal making here in America quite dramatically. The first policy punch were Beijing's pullback on liberal outbound FDI policies in late 2016 and 2017. Beijing had gradually liberalized outbound investment policies since 2000, and in 2014 we gotten to a point where almost all restrictions on outbound FDI, commercial outbound FDI by the Chinese corporate sectors were lifted, which was one reason for why we saw such a big growth in 2015 and 16, in addition to other macroeconomic and firm-level drivers. In 2015-16, the outflows got so big that Beijing got cold feet and had to impose capital controls on all sorts of outflows, including portfolio investment, but also including FDI. These informal measures came towards the end of 2016, late November, I believe it was. And as you can see, there's a pretty close correlation in terms of the timing when these measures came out in late 2016, and a big slowdown in newly announced transactions in the US and globally. That was a global phenomenon. This new outbound FDI framework was formalized in August 2017, so we had about 8 or 9 months of uncertainty where nobody really knew what the policy stance was. And since August 2017, we have a new outbound FDI policy that is based on a list approach that we already know from inbound investment into China. So we now have a new regime that looks at prohibited, restricted, and encouraged sectors. There's increased scrutiny on the Chinese side on outbound deals. And I think Dan is going to talk about that a little more when we get into the outlook section. The second policy punch was certainly a change in U.S. policy, and most importantly, the CFIUS process. We already heard David and Eric discussing how the Committee on Foreign Investment in the United States is reviewing foreign acquisitions in the U.S. Traditionally, CFIUS has taken a very narrow approach, but certainly since at least the final year of the Obama administration, there have been some changes in how CFIUS looks at transactions in certain sectors. The big apparent sectors, semiconductors, that triggered a reassessment of some of these technology transactions. And so we saw quite a few Chinese transactions in 2017 being, well, I wouldn't say blocked because most of them weren't technically blocked, but there were parties were encouraged to abandon transactions because of existing national security concerns. Most of the deals, and I just put up a few big ones here, were in the tech space, but we also had these new debates about personal data of U.S. citizens come up, which were apparently a problem in the MoneyGram transaction, for example. And we also had 1 or 2 other cases, aluminum and the financial sector, for example. All in all, we estimate that CFIUS led to about $8 to $10 billion worth of abandoned transaction in 2017. So on top of Beijing's more restrictive outbound policy, a more active CFIUS also contributed to that big decline of Chinese deal making that we saw last year. And these policy shifts have directly impacted not just the level of Chinese investment, but also the composition of deal flow by industry. This is the same chart as I just showed for U.S. FDI into China. It is a little more volatile and concentrated because it is more dominated by big M&A transactions, so you don't see that nice correlation. But two important perspectives. First, you see already in 2017 the impact of new Chinese policies. Look at the drop in real estate, for example, or the decline of entertainment investment. Both of those are sectors that are on those new Chinese lists of prohibited or restrictive sectors. And then certainly on the U.S. side, the 2 dots that would have been higher up in the rankings if it weren't for a more active CFIUS would be ICT, which would certainly be the biggest industry if it weren't for CFIUS. And then I would also argue that financial services would be all the way up there in the right top quadrant if it weren't for U.S. policy intervention. So we're seeing clear shifts in the level and composition of inbound FDI, and those changes are also certainly impacting local economies here in the U.S., and that's the second study, kind of building a bridge to the second study that we're releasing. New Neighbors, which for the last 3 years have been assessing the local implications of Chinese investment in terms of jobs, investment, taxes, innovation, and the likes. And we put out an update of those numbers as well. They're available, I think, in hard copy form at the entrance here. The key findings from the New Neighbors report are that 98% of all U.S. congressional districts today are hosting Chinese companies currently, but the slowdown of investment in 2017 has had a big impact on some of those traditional metrics that we've looked at before. Most importantly and most apparently, we've seen a slowdown in Chinese companies adding jobs in the U.S. So for the last 5 or 6 years, we've seen a dramatic increase of employment associated with Chinese-owned enterprises in the United States, all the way from just a few few thousand in 2007-8 to about 140,000 last year. In 2017, the rate of job additions has slowed down to only 7,000, and that's the lowest rate, the lowest increase in 5 years. So a clear impact here on the local level and how local officials are thinking about that prospect at the moment. At the end of the year, we had about slightly more than 140,000 employees at majority-owned Chinese companies, and an additional 10 or 20,000 at companies in which Chinese investors have a minority stake. So all in all, about 160,000 American jobs associated with Chinese ownership here in the U.S. The other trend that is new is a rapid increase of canceled transactions or divestitures. So we already talked a little bit about M&A, and some Chinese companies are now being forced to divest some of their overseas assets. I think the big news over the last couple of days was that H&A is putting up its 25% stake in Hilton hotels up for sale. The big private conglomerates that are under pressure to consolidate their balance sheets are starting to divest U.S. assets. And more importantly, what I have here on the slide is that we saw a big jump in canceled Greenfield projects by Chinese companies. So we had quite a few examples already in 2016 where Chinese real estate developers, manufacturing companies ran into trouble getting money out of China into the U.S., and they had to cancel or dramatically scale down their capital expenditures for Greenfield projects. And those are the most important projects for local officials, of course. And in 2017, that number went up to $6 billion. So quite a few big real estate developments in coastal cities, but also factories that were announced in 2015-16 were canceled or at least put on ice. So that is a very important shift that local officials will have to take into account when assessing opportunities related to Chinese investment. And my final task before I hand it back to Dan is to point you to our online resources. We've created a great interactive based on a two-way street data, U.S China FDI.com, which allows you to explore our two-way FDI data in great detail by state, by industry, by ownership, by type of investor. So please pay a visit to that website and play around a little bit with the numbers. Thanks for your attention, and back to you, Dan, to talk a bit about the 2018 outlook.
Excellent. Thilo, fantastic job cracking the seal on this new bottle of wine to share with our friends. There is a lot more where that came from in the reports. Please set aside some time to fully work through and digest the analysis. It's very rich, and it's very important right now. I'm going to finish up this portion of the program with just a couple quick observations about the outlook, looking ahead, now that Thilo has done everything that could be done to bring us up to speed on what's happened in the rearview mirror. And then we'll turn to what's going to be a fantastic panel with some colleagues to offer a variety of different perspectives on how all this fits together. On the outlook, I'm going to make a very brief comment with regard to the prognosis for U.S. outbound investment to China, Chinese here to the United States, and then the overall relationship in which all that takes place. Starting with the U.S. to China side. Recently, a very senior American official said, good news, there's a pot of gold waiting for American firms willing to cross the dark seas and find their opportunities in the People's Republic today. But the basic impediment, barrier to getting to that pot of gold beside the leprechaun under the rainbow is that there really are still some very profound policy issues at stake. There are asymmetric conditions in terms of investment market access in China versus investment market access in the United States. This draws from OECD work that's used to try to score the extent of policy barrier in different economies, including China and the United States. And you can readily see that virtually across the board, the level of impediment on the Chinese side, not just the most formal barrier confronting a firm in the foreign investment laws, but the whole range of formal and informal barriers that make it possible or difficult for firms to operate in China versus the United States are really quite profound in all industries that we track, aside from transport, where the Jones Act and traditional American restrictions on foreign participation in U.S. transport sector mean that we're in a very similar position to China. But by and large, we have an asymmetric picture to deal with here. And nowhere is that more apparent than in looking at this issue through the lens of joint venture requirements. And, here we are having a kind of brinksmanship debate about whether Chinese firms will be allowed to build their companies here in the United States, make acquisitions in the United States, whether American companies can build their businesses in China, but we're still debating whether American companies can own their own businesses in China. Because in way too many sectors, as the chart suggests, energy, financials, entertainment, even in entertainment, something as non-strategic as a theme park, it is just not permitted for an American firm yet to have full control, 100%, or even a high level of control in many cases of their own business. This is a legacy of a time when China was not an advanced economy like us, but a developing economy, and certain, indulgences, if you will, concessions by the developed nations, hoping that China would be able to catch up more quickly, were made. That era is no longer appropriate to the current moment, with China being as large and important a part of the global economy as it is. So this chart's not going to go away. And until the essential asymmetry in this ownership stakes picture is resolved, we're not going to be able to fully move forward. Good news, of course, as Thilo mentioned, is that there are a lot of Chinese commitments to start converging toward an assumption that firms should be able to own 100% of their businesses, right? So China has essentially acknowledged that that is the right endpoint. The question is how long it's going to take to get there, and whether making that commitment is the same thing as making it possible for firms to truly take control of their own businesses and brands on the ground in China. The next point to consider in terms of the outlook is on the China to the United States side. We've seen what the potential is in recent years, as we saw the numbers grow up to the peak of $47 billion that we saw in 2016. And in fact, that was nothing like, saturated. China has miles to go and years to go before it is adequately invested in the United States. Chinese manufacturers enjoy hundreds, as we are reminded every day via Twitter and every other media that we have available to us, Chinese exporters enjoy hundreds of billions of dollars of market share in the United States. But very, very few of them have a direct, on-the-ground, face-to-face relationship with their customer. Very little after-sales and service. Very little direct brand customer relationship. Most of China manufacturing is intermediated by a U.S. retailer or by an American business partner. At a time when China is no longer the low-cost producer of socks, underwear, toys, electronics, and many other things, that is not going to work for them in the medium term, let alone the long term. If China Inc. does not invest here, China will not be able to maintain its trade share in servicing American demand. That's just a reality. And of course, the corollary is just as true, that if American firms aren't allowed on reasonable terms to be invested in China, they won't be able to export to China, service Chinese demand, etc. down the road. That's the problem we have here. On the Chinese side, of course, as Thilo noted, we're actually going somewhat backwards after a time of Chinese liberalization of the outbound direct investment regime. That, of course, is what kept China at home over the past 30 years, not foreign barriers and impediments, but Beijing's barriers and impediments to its own companies. Out of various concerns over the past 2 years, an outbound regime was reimposed. And this elaborates it a little bit more in terms of what's encouraged, what's restricted. They got a chance, as David said, but, that's not quite the same thing as all you have to do is notify us, right? And restating what's prohibited in terms of outbound investment, including in such strategically important industries as soccer teams and stuff like that, where the Chinese authorities have seen fit to insert themselves in what private firms are trying to do. Now, this was, of course, motivated by balance of payments concerns in the first instance. When that drawbridge first started to get pulled back up, late 2016, 2017, it was driven by the reality that over $1 trillion of China's foreign exchange reserves had been sent out of the country in as little as 18 months. And we see that here when we look at the balance of payments pictures, that financial account, the orange bars underneath the zero line, means that was a net outflow from China per quarter. So that, combined with what we call errors and omissions, there were $250 billion a quarter net leaving China in those at that time. And that was the initial impetus to reimpose outbound capital controls. Those balance of payments concerns have subsided now. China's no longer confronted with that sort of quarter-to-quarter concern about capital flows. However, the fundamentals haven't really changed for China in this regard. The official line out of Beijing these days is that the economy is in excellent shape, and there's really nothing that would drive capital outflow from the country in any concerning sort of way. But when we at Rhodium look at the policy reform fundamentals, this is something we do call dashboard, we see that in almost every major reform area, China is not presently making progress against its own early Xi Jinping era third plenum 60 decisions reform program. If you remember that oldie but goodie from a mere 5 years ago, laying out a comprehensive economic reform plan, not seeing very strong progress right now in terms of fiscal reform, financial reform, et cetera. And until those fundamentals are addressed, China will be at risk of renewed balance of payments concerns the moment that international conditions invite capital flight from the country. What would most do that? Higher U.S. interest rates set by the Federal Reserve at a time when China's People's Bank is loath to raise domestic interest rates inside China for fear of putting companies into bankruptcy. That's exactly the outlook for 2018 right now. So I don't think China feels out of the woods yet in terms of these balance of payments motivations for trying to keep some additional control on outbound investment, not least to the United States. Adding to those fundamentals of balance of payments issues and macroeconomic reform factors that I just noted, we are passing the baton of impediment here from Beijing to Washington. And not just Washington, but Berlin, of course, Paris, Canberra, Ottawa, all around the world. And in China, too, as we've seen with Beijing restating its concerns about Chinese intellectual property. This is a global phenomenon. Our technology has outrun, if you will, the preparedness of our policy regimes to be comfortable in terms of the implications. As Deputy Assistant Secretary Tuning said, we can't just be concerned about what has a military application today. We have to think, can we imagine any kind of vulnerability from everything we do tomorrow? Maybe soft serve ice cream could turn out to have some, nefarious use if put to work in the wrong way, right? It's almost limitless what one might imagine could be concerning. It's going to be very tough here for all of us. And it's not a China thing. It's not an American thing. It's a technology thing. And we've all got work to do to better redefine now and establish where we're going to draw the line about what's concerning and what's not. Add to that, of course, the larger trade and economic policy issues, which are bilateral in nature between China and the United States, and we have a very fraught policy environment presently. We note just three things on this slide, and you all know them intimately well, so I won't harp on them, but the 301 decision issued by the White House last month includes a foreign direct investment element that has not yet been elaborated, but will be elaborated soon, and is going to propose probably a new policy consideration on the American side. We have the FIRMA legislation that's already been discussed quite a bit that hopefully in a reasonable way will sharpen and brighten the boundaries around theories of concern and harm that could arise from foreign investment in the United States generally. It's not a China-specific piece of legislation, although there's no doubt that it will weigh more heavily on flows from China than almost any other economy out there. And then there are other things as well. The ECRA legislation that's been proposed that would modify and enhance export control authorities here in the United States, so that the next time David tries to interrogate Eric on that topic, he might be able to get a better answer from our friends in Five-Sided Buildings about whether export controls can take some of the burden here, so it's not all on CFIUS to solve this problem, which is more than really is more than just a CFIUS problem that we're dealing with. Just one or two other points I want to make. FIRMA is, as David noted, at its heart about high technology. That is the biggest motive behind these re-legislation, re-evaluation of our policy regimes. That, in turn, is in large part due to greatly enhanced Chinese participation in early-stage venture capital investing in the United States. In the report in Two-Way Street in front of you now, you'll find a full-page text box that shows you some of what Rhodium's trying to do at the cutting edge so that next year we don't bore you with just the same old charts, but have something new to say that better evaluates and illuminates what's happening in this venture capital space. But suffice to say, yes, it's true. There is an extraordinary uptick in China-related early-stage venture capital investing in the United States. Bear in mind that there has been an extraordinary American involvement in venture capital investing in China for decades now. And this is a dimension that'll be a little bit different between the U.S. and, say, France and the United Kingdom and elsewhere in the OECD, just because the U.S. has such a bigger innovation economy in Silicon Valley, Austin, Texas, Hook'em Horns, and Boston, for instance, than most of the other OECD economies have. So this will be a particularly American aspect of managing the new era of investment relations with China. And penultimately, the reciprocity discussion at the heart of the matter is not going to go away. We would observe that the FIRMA bill, for all of its expansiveness in changing the definition of what's concerning in national security terms, doesn't even begin the conversation about whether reciprocity needs to be an element of our relationship with the People's Republic of China in direct investment terms. The same asymmetries that I discussed before in terms of joint venture shares are easy to demonstrate with evidence in terms of the tariff rate in trade and services trade restrictiveness, and certainly in terms of FDI restrictiveness as well. Until we solve that, we're not going to be able to get back to a stable place in our relationship with China. Finally, as we think about throwing up our hands and saying, enough already, let's just kill them all and let God sort them out, in terms of firms who over the course of almost 4 decades have taken chances, taken risks with their shareholders' money, with their own funds, with their time and their careers, and many of us have been involved in this, to set up a direct investment presence in one another's economies, which mark to market today, as Thilo noted, would easily be over $500 billion of assets at risk. We need to be fairly careful and thoughtful about how we seek to modify, shake up, change, and hopefully reset the bones of our bilateral direct investment relationship with China. There is a very large pool of ballast, shall we say, at risk from a disruptive, haphazard disengagement from one another. And we have lots of reasons, hundreds of billions of reasons, in fact, to be somewhat careful and cautious in how we proceed down this path. Thank you very much for your attention, your interest in this work, and we're about to have a fantastic panel discussion. Thanks.
We got a terrific panel. We've got I think everybody's known to everybody, but let me just go over who everybody is. We've got Amy Selico, there in the blue, who's a principal at Albright Stonebridge Group, and she leads the firm's China team here in D.C. and has been working on trade issues with China for as long as I can remember, which is a long time. Steve Foland, in the blue tie, we got a lot of blue today, who is Managing Director and Head of Banking Americas for China International Capital Corporation, which, if my recollection is correct, was founded by Wang Qishan and Morgan Stanley. We've got Ken Jarrett, who's president of the American Chamber of Commerce in Shanghai and has been working on China in the State Department for as long as I can remember also. So it's great to have Ken here. Of course, the Chamber is one of the sponsors of this. We've got Al Larson, who's replacing Dave Fagan on the panel, who is now here as a non-lawyer at Covington, but had an incredibly distinguished career in the State Department, where his final position was Undersecretary of State for Economic Affairs, which, as you all know, is the highest economic job in the State Department. And Dan Rosen, of course, the founder of the Rhodium Group, who had a long career working on economic issues with China and studying what's going on. Was founder of the Rhodium Group and at the NSC was working on economic relations with China way back when, Dan, right? Let's start with Ken. Talk about your membership in Shanghai and how they're feeling about the investment environment in China. You know, and are they concerned about, there's been stories in the press about the tit-for-tat tariff exchanges, if they start occurring, that China runs out of the ability to tariff U.S. goods and begins to retaliate against U.S. businesses that are in China.
Perhaps you have two questions there. One is, I guess, the impression or the reaction to the investment climate, and then the response to the current environment between the United States and China. So in terms of the general environment and our membership, so it's about 1,500 corporate members, just to give you a sense of the scale of the membership. And it's a broad mix of companies. It includes the large multinationals, but increasingly most of the new members are small and medium-sized companies and entrepreneurs, people who are coming to China to see what opportunities are there. And companies in general have two reactions to the investment environment. One would be the lack of progress on market access. So that's a familiar concern to, I think, to most people in this room. You know, the sense that since China's accession to the WTO and assumption that the market would open up over time, that this simply hasn't happened fast enough. And at the same time, the second concern is the increasing use of industrial policy. So as you have less market access, less opening of the market, a sense that the government is relying more on kind of a state control of the economy. And so our members are getting squeezed in between these two areas.
In all sectors or in specific sectors?
And it's important to also make the point that many U.S. companies are actually quite successful in China. You know, this is a point that gets overlooked a lot, particularly here in Washington. And you know, this is demonstrated in the multiple surveys that come out both from the chamber in Shanghai, but as well as a chamber based in Beijing, where the percentage of companies that are profitable is quite high. And the last year or two, most companies have enjoyed revenue growth. And this reflects, I guess, Steve, to your question as to which sectors. China is increasingly becoming a consumption-driven economy, and so those companies that are in consumer-facing businesses are doing, particularly well. But there's also a strong sense of optimism in healthcare, for example. But on the second question, in terms of the current atmosphere, there is a growing anxiety within the American business community about what's developing between the two governments and the tariff tit for tat. At the moment, it's simply notional lists, and no lists have been finalized nor implemented. But already, putting aside the tariff lists, there is a concern that within China, either Chinese consumers or local officials are already reading the tea leaves, so to speak, in China and starting to behave differently. So, for example, I've heard from a number of our members over the last couple of weeks that if they were thinking of some kind of expansion or seeking approval for a new operation in China, that this is not the best time to submit that kind of application. So it's already starting to dampen some of the activity, and this would be sort of one big concern.
Interesting, rather than, because what I have suggested in both my public speeches and in meetings with the Chinese government, it's the time for the Chinese government to woo the U.S. business community, not to turn it away, so that in fact it's a time for U.S. companies to expand in China, because the Chinese government should actually be much more welcoming of U.S. investment, because there will be no big surprise that during the MFN and the PNTR debates, there was often a difference of view between the executive branch, the Congress, and the U.S. business community, which the Chinese exploited very successfully.
That's the argument that we use as well with Chinese officials, but whether or not they see it the same way is the question.
Dan, the pot of gold, what sectors do you think the pot of gold exists in? What could the Chinese do which would make our numbers go up enormously in 2019 and 2020?
Well, look, China has a continental-size economy. It's the largest population on the planet. There's really no sector which doesn't have potential in every industry, and this is why the United States traditionally, in evaluating inbound investment, didn't have negative lists of specific sectors, that even within a sensitive sector, whatever you consider that to be, say, aviation or energy or technology, there are some niches and elements which are not so sensitive, which should be investable. And that's absolutely true in China. Across the board, there should be room for greater foreign participation in China's economic growth. That said, kind of matching China up with particular American capabilities, in American high technology and computing, especially on the services side, so cloud and all these capabilities which are reshaping our economies today, there should be vast growth in American participation in China's economic development at this phase in time, moment in time. In healthcare, China is, I often am pointing out, trillions of dollars short of hospital and healthcare sector assets in its own economy. America, if anything, is a little bit over-doctored. We have, pretty good experience building out a healthcare system. How efficient it is another question, but a lot of things we should be doing in China in healthcare that our major players want to be doing and are still looking for a way to get growth going faster. Financial services as well. And then finally, just to point out that it shouldn't be excluded, even traditional manufacturing sectors like automobiles, anywhere where you find American investors with billions of dollars at work, but only permitted to own 49% or 50% of their own company, they, at this point in time, need to be given the opportunity anyway to acquire the rest of the firm. They're buying a profits interest, if you will, in their own business, in the business that they've built, that they're largely responsible for the P&L of. Nowadays, I'm not sure that every American auto company would buy out the other 50% if they were given the choice. That's a complicated question in today's global economy, but they need to be given the opportunity to do so. And if they all did execute that option, I would be winning my bet with Thilo in terms of next year's flows, where I'm still looking for reasons to be optimistic. But, tens and tens and tens of billions of dollars of potential American additional investment, even into existing American JVs in China today.
Steve, a great opportunity for CICC to value those stakes, to determine the price at which they should be bought out at, because it's be no mean feat. Amy, we've seen appointments of an extraordinarily pro-reform economic team in China. Not only Wang Qishan, who I mentioned was the founder of CICC, along with Morgan Stanley. We've seen a Seton Hall, Harvard-trained person in Liu He being named to the Politburo, and now, Vice Premier. We've seen Yi Gang, a University of Illinois PhD in economics and a former professor at the University of Indiana. What do you tell your clients about what this means for kind of their investments in China? Does it mean that Dan is going to win his bet with Thilo? Does it mean we're going to see a opening? And if so, how and where?
Well, I certainly tell our clients at Albright Stonebridge Group how encouraging it is that President Xi is relying on folks like those that you just mentioned, because they are known to be protégés of Wang Qishan, and so have a real history of looking outside of China's own model to talk about economic growth. However, they're operating in a very constrained environment where, fundamentally they are fighting two competing priorities. One is to enhance the role of the party over every aspect of Chinese society, and of course that includes the economy and economic activity by foreign and domestic companies, and then the priority to continue to grow. And so I do think that these very well-trained economists and economic advisors have to really reconcile themselves with what President Xi has said, which is the Communist Party knows what's best for China. China Inc. industrial policy is good for Chinese growth. And so for foreign investors looking at the market, they are saying very much to what I think Dan was just mentioning, there are tons of opportunities within this model, but there continue to be real constraints. And so, in 2017, I think we attributed to a lot of the slowness in China just being that it was going through such a massive political transition. All eyes were focused on what was going to happen at the Party Congress. And what happened and what just finished in March at the National People's Congress was a restructuring of the government, was President Xi certainly consolidating power, naming the individuals that you just mentioned, Steve, to power, but not necessarily indicating to us that this is going to return to that ancient document that Dan also talked about that was going to promote, market-driven reform of the Chinese economy. In the ensuing 5 years, I think the Chinese government has said, actually, a more statist approach is best for China. And I think where Albright Stonebridge Group clients and all of you in this room are struggling to think about short-term next steps is the Chinese government right now, these very well-educated advisors to President Xi, going to win the day in saying we need to demonstrate that our Chinese approach still welcomes investment in our market by foreign participants?
Why would he if he didn't want to move forward with third-party plenum reform, so really a strong continuation of reform and opening, why would he have made these appointments? He wants dissenting voices around him?
I don't know that these are dissenting voices, though. I think that...
I think in terms of, well, if you've, I think a lot of the people in this room have dealt with those folks for many years. Mm-hmm. I certainly have. They are fairly outspoken in their support of reform and opening and the third plenum reforms. I think one of them was an author of the third plenum reforms. So it leaves me puzzled when we have the statist approach on the one hand and then appointing people whose economic views don't differ that substantially with a lot of people in the United States who are very pro the market being the leading force. So it's puzzling.
I think, the speech that President Xi just made in Boao yesterday is encouraging to many of us, although it certainly didn't include some of the breakthroughs that some had promised. Liu He, when he was actually at Davos, said, we're going to make announcements very quickly, specific liberalizations. Those weren't mentioned in this speech. However, President Xi did talk about things that clearly his advisors are pushing. And, I'll run through very quickly his 4 themes, improve the market environment, improve market access for foreigners, improve the investment environment for foreigners, and then provide, strengthen the intellectual property protection regime in China for the benefit of foreigners and, of course, the domestic economy, and then increase imports. And so, Steve, as we're all talking about these questions, certainly his advisors pushed some of those elements. It was also a very restrained speech in that it didn't certainly move any of the rhetoric forward that we're reading in the People's Daily. He did not call out the United States, although certainly he spoke about zero-sum mentalities and Cold War mentalities being so bad for the global economy. But these economic advisors are advising President Xi that China can be a model for the world, but that model does have to include openness that, like you said, they've advocated for many years.
Let's look at flows the other way, and I'll start with Dan, then go to Steve, and then go to Al. In your presentation, Dan, you talked about kind of the 2 factors that have been slowing Chinese investment, one being capital controls, one being CFIUS. Can you, if neither of those had been factors, can you kind of guess what the number would have been and then allocate a percentage to each of the stumbling blocks? So,
No. I mean, one could.
Well, you do on CFIUS. You do on CFIUS.
Yes, I could do that, and who's going to argue with me, because I've got Thilo to work with me, and nobody's going to want to argue with him on this topic. But look, I think all that one needs to say is the order of magnitude, right? Across all of these channels, all these industries and sectors, where China is today compared to where an economy of $12 trillion, the size of an economy, will need to be to sort of be at its kind of plateau point in terms of international investment, very primitive stage. It seems like a lot of money has already started flowing, but this is really quite modest when you look at the level of flow between, say, the United Kingdom and the United States on average over the past several decades, right? So we've got a really long way to go, and it's a false choice to think we have to choose between national security and large deal flow. We can have both. We could double, triple the diligence with which we screen for truly legitimate security concerns, and we must and will do that, make no mistake, and at the same time accommodate 2, 3, 4 times is what we've suggested in some of our other work, say $100 billion, $150 billion, $200 billion of deal flow. That's only 4 Syngentas, right? We're not talking actually about some epic amount of activity flowing here. That is the size of world-scale M&A transactions today. So plenty of room to go. But I'd really like to hear what Steve has to say about that, because CICC is the kind of institution that's going to need to be able to bank that sort of activity. Am I being too optimistic?
Absolutely not. So let me address a couple of things that a number of people have been talking about, and one goes to really sort of the environment, the appetite in many respects, and Dan, to your point as to whether or not you're being too optimistic. From I think the Chinese perspective, I think President Xi's comments were incredibly constructive and I think give a real sense on what a lot of the Chinese regulators are thinking about and a lot of the Chinese officials are thinking about. And I think we're seeing it in terms of the level of interest from the Chinese officials on U.S. investment. And that's both at the central government level as well as the provincial level. We see repeated level of inquiry and encouraging us from the U.S. to help our clients come over and address specifically what investments they want to make. And so there's been I think there's been no decline whatsoever in terms of levels of interest from the Chinese perspective looking to the U.S. We've seen a very constructive dialogue, notwithstanding all the political noise that we read about. At the actual working level, there's been a very constructive dialogue, and it continues to be. I think there is a level of caution that is both justified on both sides, and that is there. But we're in an environment now where, from the Chinese perspective, the monetary controls have been eased. There now is some level of certainty about what's restricted and what's encouraged. So from the corporate perspective, there actually is a clearer path now than there has been any time in the last probably 18 months. So to Dan's point is that a false level of optimism? I think absolutely not.
Are the numbers that Dan and Thilo show, the percentage decline, roughly commensurate with what's happened with your business domestically in the United States?
From the M&A perspective, it's about commensurate. We were obviously during 2020, late 15 and into 16, incredibly busy, and there was a tremendous amount of deal flow that was happening both ways. 17 has been a year where our clients have been a lot more thoughtful, and the deal flow has slowed, as you would expect on the M&A side.
Do they understand? I think David asked Eric, can we still get approval of CFIUS? Can we get approvals through CFIUS? And the answer was yes. But you think the Chinese appreciate that we're still open for business? Or do basically a lot of Chinese companies go, whatever, I'm going to go to Germany, I'm going to go to France, I'm going to go to the UK, I'm going to go to ASEAN?
What I would say is, interestingly enough, Chinese companies have become a lot more CFIUS savvy over the last 2 years, as you would expect. I think there is a general belief that transactions generally can get approved, but you need to be more thoughtful in terms of what can get approved, and there are certain sectors that you need to be very careful because the likelihood of getting approved is probably low.
Such as?
Such as, I would think that you need to do a very careful analysis, and we work with our clients doing that very careful analysis on some really leading technologies. That obviously is an area of sensitivity. There are other areas that would, at least on their face, be less sensitive, and Dan and others have talked about that. But even buried within the sectors that you would think would be less sensitive, consumer retail is probably a good example. If there are facilities sitting right next to a U.S. military base, you're going to stumble into what arguably are U.S. national security concerns. So it goes back to what Mr. Tuning said, in that it really is a case-by-case analysis. And our clients, I think, have become much more savvy about, let's find an asset that we are interested in or a company we're interested in, go through the analysis on what the strategic fit is for the respective businesses, and then before we take the next step, let's do a really detailed CFIUS analysis and see what the assessment is on likelihood of getting approval.
I keep hearing about this real estate worry. Can somebody tell me, is this a real worry? I always laugh that one of my favorite hotels in China is in Sanya, and it occupies a spot in Sanya right next to the naval base, the submarine base. And when I'm out there swimming, I can see the ships going by and even the subs going in and out. These are the base from which they launch their ships into the South China Sea, but they don't seem very sensitive. It's a foreign managed hotel. It's interesting, but apparently, you know, it's quite a concern that we have to write it into law. Is this a real concern, by the way? It is.
Of course it is. Of course it is. That's probably the best way of saying it. We're not sitting in the room when the agency is debating what's of national concern or not, but the constant feedback that we have received, formally and informally, is it is a real concern if there is real estate sitting next to a military base.
Al, you've had decades of experience working in the State Department. What should the department's role be in kind of fostering what is ultimately a beneficial relationship between the U.S. and China on the investment front? What should the department be doing that it's not doing to kind of move investment ahead?
I think there's a lot that the administration, including the State Department, should be doing to push investment ahead. One is to start from one of the points that you made at the outset, that investment really has a character of a long-term permanent relationship, ballast and so forth, and that's true. It's not a guarantee that everything will be smooth on the political front, but it's a very important contributing factor. Second, I think it's important to have clarity on what the rules of the road are. I think it's a good thing that Chinese companies are more CFIUS savvy and that they understand that there are concerns about location, there are concerns about very advanced dual-use technology, there are concerns about acquisitions that could give a foreign company in a foreign country access to personally identifiable information. Those are things that are just sort of apparent, and Eric mentioned them all in his remarks. Third, I think that it's important to really try to address the reciprocity concerns and the market access disparities that the Rhodium Group has emphasized in their remarks. Those are not the national security issue, and we need to be very clear, I think, that these are different things. During the Obama administration, there was some hope of addressing those through the bilateral investment treaty negotiations. That's going to have to be tackled differently now. But China has an interest, as I think has begun to be expressed today some, in seeing a greater openness and receptivity to private investment to help transform their own economy and make it a state-of-the-art 21st century economy with a consumer-led spending. I do think it's going to be important for the State Department and the administration to be very focused on the reform issues that we talked about in the session today. There is an issue with sensitive, advanced, dual-use technology, but this is not something that suddenly emerged. Obviously, the technologies are different, but when I was ambassador to the OECD, we had thousands of people who would come over every year from DOD, Commerce, State, and other agencies to work in COCOM and to work with other countries to control the export of sensitive technologies, in this case, primarily to the Soviet Union. We have regimes under ITAR and the EAR to control technology. They need to be modernized and upgraded. They haven't been. There's been a failing on the part of our government and our Congress. But if you're trying to control technology, you should use people who are used to and understand technology in the process of trying to control technology. That's your first line of defense. It may be that there are some reforms of CFIUS that will need to be taken to provide a second line of defense in this space. But I think one should keep in mind or keep at the forefront the whole notion that CFIUS was always seen as something that would enter into play if there was an acquisition that was a threat to national security, if it could not be mitigated, and if it was not adequately addressed by another U.S. law or statute. And so I don't think personally that we should use CFIUS on technology unless those standards are met, that it can't be met by export control laws, it can't be met by mitigation, that it truly is a case-by-case approach. I think Eric was quite right in making the point that for all of its complexity and confusion that it can cause abroad, the case-by-case approach of CFIUS has been useful in broadly ensuring that restrictions to foreign investment and foreign acquisitions are as narrowly defined as is necessary to meet national security needs. I think that's been a good principle, and we need to keep it. And those are points that I would hope that the administration or an agency like the State Department, that on the one hand is an investment economic agency and is interested in promoting economic advancement, is responsible for maintaining positive relationships with other countries, but is also a national security agency. I mean, like Eric said, he feels like he's in the middle. The State Department ought to feel like it's in the middle of this debate because it has both national security and economic advancement concerns as well as foreign relations concerns. So those are the things I would hope we could be doing.
President Trump tweeted yesterday morning about the automotive tariffs, and he's right. You know, he talked about a 25% tariff on automobiles going into China and a 2.5% tariff on autos coming into the United States. And he says, that's not fair. In 1980, when they had those kinds of tariffs, you could say, well, China was a developing economy. It made sense. It does not. It does. He's correct. It does not make sense today, and we need to have more reciprocity on the tariff side. So my question, though, is about reciprocity. He also says we're going to need to have some pain to have some gain, and that in the, again. Unfortunately, if you're a farmer in Iowa or in Kansas and you're going to experience the pain for others to get a gain, I don't know if you're going to much like that. But my question relates to investment reciprocity. Should we be moving towards investment reciprocity, where if China has a sector that's closed, which they should open? I mean, the winners on investment restrictions are the incumbents. And the people, the Chinese people, are losers when that happens. But we've been raising this now for many, many years, and we haven't seen reform. Should we force the issue by going to some form of reciprocity? I don't know. I think a lot of people have views on that. Dan, you want to start on that one, or leave it to somebody else?
I'll throw a few things out just for consideration. First, that one should not expect a kind of perfect reciprocity in the international system. Each culture, each nation is going to have its particular sacred cows, shall we call them. For the United States, it's traditionally been sugar and corn syrup, right? We've had huge departures from the general principle, right, of perfect reciprocity with other nations to protect a particular vested interest. Wealthy political people in Florida that had invested a lot of money in a business that was making a lot of money and able to make a lot of political contributions to sustain an exception from general U.S. trade openness, right? And that's okay. Other folks had their sacred cows that they were going to insist on an exception for. Europeans have an agricultural policy which is more protective than ours in general, right? But we still subsidize to some extent some elements of our farming and agricultural community too. So perfect reciprocity is not the goal, but we do need to be in the same basic ballpark, right? And China's coming from a time and place when it was truly a less developed, very poor country, which, you know, if you're over the age of 30, you remember that, even though that was like day before yesterday, right? Very rapid evolution in China's story. But today, it is no longer just that poor country it was. In fact, it is at the cutting edge. It is the most competitive telecommunications nation, economy, player on the planet. In all, you know, for all practical purposes. And so we need to assess the question of reciprocity with a different standard. We need to be much, much closer to comparable in terms of the general principle of openness we apply to one another. Nothing but that kind of convergence toward a shared like-mindedness about trade and investment openness is going to get us to where we want to go. We're either going to converge down to protectionism, or we're going to converge up to liberalism. And I'm still hoping for the latter.
Steve, anything on that? I would just echo really one of Dan's comments that it's unrealistic to expect sort of perfect reciprocity. And largely, if you think about where both China has come from and sort of their national interest as defined, you think about where the other countries, the U.S., you know, how the U.S. has approached that issue, it just, the conversation has to be in the context of stated national interests. And I just think the conversation needs to be around what can reasonably be achieved with, you know, a fundamental decision around the debate as to where on the spectrum, as Dan said, do you want to end up, still understanding that there are going to be some sacred cows, you know, in that discussion. Al, anything?
I think convergence is definitely the direction we want to go. A serious question is how do you get there? Ronald Reagan used to really irritate some by saying, it's like you're sitting in a boat and the other guy shoots a hole in the bottom of the boat. So for reciprocity, do you take out your pistol and shoot another hole just for reciprocity's sake? I think that, you know, we all have been slow. When I say we, the nations of the world have been slow to have multilateral investment disciplines. One of my many great failures as a diplomat was to try to get a multilateral agreement on investment. The French sunk it, but it could have been, you know, a number of other nations because of the sacred cow issues. I think that investment treaties of the sort that the United States has negotiated are a means of getting a level of general reciprocity, not mirror image reciprocity, not I do exactly and identically what you do, but a balance of benefits reciprocity. Maybe we'll get to that someday. If we can't get to it right away in an international agreement, then we need to get there in a more general way of sort of political reasoning and accommodation. It seems naive to say so, but it literally is in China's interest to have many fewer investment restrictions. It's in the interest of the United States to only have those restrictions that are necessary, in our view, to protect national security.
Right. Amy?
Yeah, I don't think I have much to add to what's been said, other than to remind folks that there is a difference between the United States wanting to invest in Chinese media services, obviously one of those sacred cows because of China's governance system. That's not going to happen. But when we talk about cloud services, I recognize there's a broad national security concern, but we should define national security in a way that doesn't restrict new technologies like cloud services. And so I do think we don't want to race to the bottom. We don't want to close our market the way that that China has been closed. But in these discussions, which I agree with Al, a bilateral investment treaty really allows our two countries to talk specifically about sectors. That's where we need to be focused, saying this is where China, for China's interests, but also for global standards, needs to open up.
Great. Ken, anything on this?
Reciprocity is a word that keeps coming up, and it's one that we've been talking to our members about as well. And the challenge for everyone is trying to, even if you feel that being more reciprocal is a way to go, how to do this in an intelligent and smart way, to turn this into, to operationalize it or to develop a strategy around it, upon which I think many people are, within our membership, reluctant to start to go too quickly down that route. But the reason why it keeps coming up as a word is partially related to the theme of the program this morning, which is the flow of Chinese investment into the United States, because this large flow has simply highlighted some of the asymmetries, to use a different word than reciprocal. And the asymmetries in investment flows then simply heighten the sense of unfairness, which is at the core of what bothers much of the American business community in China.
Steve, can I just add one thing? It has not just heightened the asymmetries, but it also has heightened that China is not a developing country anymore, and it shows that Chinese companies are able to compete head-to-head with American companies, foreign multinationals, in their home markets. And so we need to leave that position. China throwing up its hands, we're a developing country. They're not. If you look at Shanghai, Beijing, the per capita GDP is close to OECD levels. And so I think China needs to get back to that track and converge upwards. Otherwise, it's going to be very difficult to continue the openness here.
Are we seeing a diversion of investment to places outside the United States? Is there any evidence that kind of the negative atmosphere created by the perception that CFIUS is enforcing much more tightly, and this potential trade war with the United States? That could be for Dan, it could be for Steve, it could be for anyone, because Steve, you might hear it in the very early stages where you're at a meeting and they're talking about, boardroom, and they're talking about 4 potential acquisitions, 2 in the United States, 1 in Germany and 1 in the UK, and they say, forget the US, let's just more easily go. Or Dan, is there any data?
Want to go first?
Sure. My comments are a little more anecdotal than empirical. But Steve, you're absolutely correct. When we're sitting in meetings and with Chinese corporates in particular, talking about potential acquisitions, and if there is a list of targets around the world, oftentimes the discussion really will focus on how difficult would this be to get done in the U.S. versus whether it's someplace in Europe or elsewhere in the world. So although there is still significant interest in U.S. assets and U.S. corporations, there is a natural handicapping going on by Chinese boards of directors as they think about degrees of difficulty. So there's a little bit of a self-selection process in the current environment.
Dan, any data?
Well, yeah, we've run those numbers globally, and what we're seeing in the U.S., by and large, is a global phenomenon. It's not America specific. 2017, Chinese outbound direct investment, pretty much throughout the OECD, fell off at a significant level for the first time in a decade. The downturn in the U.S., a little sharper than in the European Union, for instance. There are a couple outliers. The United Kingdom actually saw a modest uptick last year in inflows from China, mostly associated with 1 or 2 deals. Again, at the early stage we're still at really right now, 1 or 2 deals can change the data picture quite significantly. So that's a really important caution for everybody to bear in mind. We're not sort of up out of the weeds yet in terms of the very noisy data, even with the tremendous amount of care and diligence that we put into it. All that said, looking ahead for just a second, could this be a bigger diversion from the U.S. to the European Union, for instance, something like that story? Again, come back to understanding what motivates direct investment flows in the first place. Chinese firms, of course, are looking to tap into intellectual property. That's why companies do acquisitions, right? That's not a Chinese thing. That's a profit thing. That's a company thing. That's a market thing, right? And there's really no other economy in the world that has the innovation systems such as the United States has. In California, Texas, North Carolina now as well, Boston, New York, here in Washington as well. There's an amazing technology innovation cluster taking place here in Virginia around Washington, D.C. So unless you can find that stuff in Spain, which you can't, then we're not at risk of a massive diversion of Chinese interest from Mountain View, California to Grenada. It's not going to happen. Likewise, unless you can find hundreds of billions of dollars of trade surplus organized around consumer demand in Iceland, it's not going to divert from the U.S. to Iceland. It's going to be where the consumers are. Now, there's other motivations for FDI as well, some of which are very powerful, important. So just general diversification of wealth. If I were a Chinese, robber baron of the Gilded Age of Chinese wealth creation, I wouldn't want to keep 100% of my entire net wealth in one emerging country, even if it was my own called China. I'd want to put some of that wealth in a portfolio of assets, real estate, who knows, whatever is liquid and available. The U.S. has got a lot of that, but so does London, so does Australia, so does Canada, so does elsewhere in Asia as well. So some of these channels could be diverted more from the U.S. if we don't take good care of our capital markets and maintain our traditional role as a globally accessible, smart place to put your money. Back to the reciprocity point. I don't care if people take my money. I'm happy to take their money. Right? So reciprocity is not always the right answer.
A senior Chinese official who has to remain unnamed, given what I'm about to say, said to me, capital controls are stupid. The Chinese people are very smart. They will figure out a way around capital controls, whether it's through over-invoicing or various other methods. An economy the size of China cannot successfully, that's so open, cannot successfully enforce capital controls. And what it does, it creates a run on your currency, because by definition, capital controls create fear among people who are holding your currency. Now, unfortunately, that comment was now 18 months ago, and the capital controls have remained in effect. It's, I think, Dan and Thilo's data show the primary cause, more than CFIUS, of the drop in Chinese investment. What do you think is going to happen with capital controls? Is it just going to remain in effect? Is it going to change? Is it going to begin to wear on the edges and ultimately just become a minor influence on capital outflows? Who wants to take that one?
I'm going to make a comment that's a little broader, but I think it's something that probably should be said, and it touches on, I think, capital controls. I think when we're talking about the way in which we want to see the investment relationship between China and the United States evolve, and how we want to ensure that the national security controls that can affect foreign investment are as narrowly targeted as possible. And we want to make sure that the trade relationship comes out of this rocky period and that some of the real problems are resolved. It is important to recognize that we're talking about two massive economies with two fundamentally very different economic systems. And so it's in that context I sort of make the point that in China, it is still the case that if the president and the chairman of the party sort of says, here is a goal for our economy going forward, that is a statement that will spur lots of actions, including massive flows of capital. Capital is allocated largely by the state. And in the United States, it's still allocated largely through private markets. So I think that if I were to try to answer directly the question you asked, I'd say, well, I don't know with precision, but it's sort of inherent in the way that the economy is managed that there would be an instinct to control outflows of capital, just as there's an instinct to control the allocation of capital within the country. And when I had the privilege of leading some economic dialogues and we were talking with high Chinese officials in a non-negotiating format about just simple things like how do you cool an overheated economy, it was really interesting to hear the different perspective you'd hear from Fed governors in the United States and from those of very influential Chinese officials. So I actually agree with the high official who said that it's a stupid idea and you can't control it and people will work around them. I would like to think that there would be a easing of things like that, just as there would be a easing or a liberalization of some of the other fundamental rules of the Chinese economy. But I think reality forces us to acknowledge that those are things that are going to take time and that we're going to need to work through this difficult investment relationship in an environment where our two countries operate on very different systems.
Others who want to comment on that?
Sure. Let me start with, because I think, Steve, you were making the comment that the thinking initially was that even with the imposition of capital controls, smart people would figure out how to get around them. And although I think that was everybody's working assumption when they were first recognized, because if you're going back, there was no absolute firm announcement by the Chinese government about the imposition of capital controls. It just all of a sudden started happening. And I think when you look at the data, and it's certainly in the Rhodium Group's data in 2017, the imposition of the capital controls, there were very few workarounds. In fact, if you really want to think about what the contributing factors to the decline in FDI has been, outbound from China, is that for a period of time there really was no way to get around those controls, and Chinese corporates were very disciplined about not trying to get around them, because although they may have figured out a way and they may have had cash offshore, we had a number of clients who said, yes, I probably could make this happen. However, we have been told formally or informally that this is not something that would be encouraged. So there was a little bit of the self-imposition. The current environment, and why I think we as a firm, and I personally am a little more optimistic, is that we now have a list, essentially a list from the Chinese government that said these are the sectors that are encouraged, and these are the sectors that are not encouraged for offshore investment. So we're at a unique point in time where there are rules, and Chinese corporates can now act within those rules, and they know what's approved, they know what they can look at, and assuming that they are within the defined parameters, access to capital will be available.
Ken, go ahead.
Well, the comment by the senior official, it doesn't surprise me, and I presume that there are actually many other senior policymakers who take a similar or have a similar perspective. But it's also hard to imagine a China that would operate that way, at least in the foreseeable future. And it reflects also just the impulse or the fondness for control. I mean, not just for the financial industry, but across the board. This is a reflex in China at any point when things tend to develop in a different direction. And even in, let's say, the Shanghai Free Trade Zone, to take something that probably everyone has forgotten about in terms of a policy innovation. At one point, they were experimenting with ways to open up capital controls a bit, and with so-called free trade accounts, which haven't lasted very long. And even for, in the sense of retail level, for Chinese who are able to each year exchange 50,000 US dollars, and in the past they've pooled resources among friends and uses to make property acquisitions in the U.S., then the government has gotten wise against that and have clamped down against that as well.
Thilo wants to add something, and then if we get a microphone to Bert Keidel, he wants to add something also.
Yeah, just one more addition why capital controls were stupid. If you look at the longer term, I think it was a real problem that Chinese imposed capital controls, and then especially the way they imposed it in an informal manner, because it has tremendously increased the uncertainty on the sell side dealing with Chinese buyers. Right, so they already had to pay really significant premiums for getting into transactions, and the uncertainty around is a Chinese company be able to get that money offshore, and is that company going to be in the crosshairs of Chinese regulators, right? I mean, your clients were wise to not take that money out at that point because they might be in jail today. So all these things have really changed the psychology quite a bit here on the sell side, and that certainly will be a longer-term impact on the ability of Chinese companies to get into certain transactions.
Bert.
Yeah, thanks very much. Sorry, I just wanted to go back to the word stupid. The Chinese word was probably 笨, 就很笨, and 笨 can be translated as clumsy. And in managing capital, I think that's what the Chinese mean, that if you just want to cut them off or open them up, 这很笨. But if you want to manage it, that's what you really need to do. And so you have these split between short-term capital flows and FDI and kinds of arrangements with Hong Kong. They would think that the financial crisis showed the wisdom of managing capital flows as they've sloshed around the world, beginning with petrodollars. But I think 笨 was probably what translated as stupid, when it also has this meaning of clumsy.
Yeah, interesting. I want to leave some time, because we have a distinguished audience, to have the audience ask some questions. So let me conclude my questioning with the lightning round. Yes, no, and you can say, but I prefer not to answer. Should the United States and China have a bilateral investment treaty? Ken, it's an easy one.
Yes.
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 Yes?
Depends. Not for the sake of having a treaty, but if we could have the right one, yeah, absolutely. Yeah.
Should the United States kind of renegotiate or reopen the negotiations of TPP and join?
Well, first, China wasn't a party to the negotiations.
That's right. I know China's not a party.
Yes.
From your lips to God's ears.
Yeah, we should, but there's a lot that would have to happen before that would happen.
I'm going to pass on that one.
Yes.
That was my lightning round. So let me open the floor to questions. I'm sure we should have a bunch. Or if not, I'll be happy to. The only people I see asking questions are Chinese media. The China Daily gets the first question.
Hi, Chen Weihua, China Daily. I have a question for Dan first. I mean, it seems to me that, in this time, it's impossible to have an intelligent, rational discussion about Russia because everything is politicized. I mean, it's increasingly becoming so about China. I mean, if you look at the messaging in the national security strategy or national defense strategy. So the question is, how much of this national security concern, Chinese FDI, is legitimate? How much is sort of a paranoid, not reasonable? So I don't know, there was a rough, I don't know, Thilo, any rough figure. If I can actually quickly ask Ken, maybe Steve, I mean, you're a moderator, but Amy talked about her thoughts about the Xi speech last night. what message do you see, from Xi's speech? Thank you.
Dan? I think almost every aspect of the current policy debate about Chinese investment is a long time coming. It's not a sudden new issue. These are all issues that have been discussed for many, many years and have been getting more and more difficult to talk about and deal with for many, many years. And the thing that changed most in the whole equation was the very rapid increase in Chinese outbound flows in 2016 that showed that this wasn't, a small, if you were, whatever your concerns were, multiply them toward the value of Chinese investment presence in the advanced economies, the answer to the equation gets much bigger when you increase by an order of magnitude from a few $1 billion a year of deal flow to $50 billion, even though, as I said, it could get very much bigger, right? So I don't think that the discussion that we're having is an irresponsible discussion or is not the right things to be talking about. Some of what you'll find in the press on both sides is ridiculous. I won't argue with that. But this is the right discussion, the one we're having right here, right now, together.
Well, on President Xi's speech, with the important caveat that I did not hear the full speech, but I read some of the summaries this morning. Well, anytime you have statements from a head of state that reiterate their commitment to opening up and things of that sort, that we welcome that. However, most of what President Xi said last night we've heard a number of times over the last several months or even over the last year plus. Thus, for the American business community on the ground in Shanghai, for us what's more important is to see tangible results as opposed to just a rhetorical reaffirmation of things that we've heard many times in the past.
The kind of underpinning a lot of the discussions about FDI is the national security strategy and the national defense strategy, and you really have to view those as related. That the national defense strategy went further than we have the national security strategy went further than we've ever gone in talking about China as a strategic competitor, talking about China as the greatest threat to the United States, along with Russia, calling China a revisionist power. And my sense when I talk, again, I'm happy I live in New York, so I only come here periodically. And when I talk to government, I have the sense that that now permeates the discussion, and we're applying standards to China that, even though it, as Dan says, it has been evolutionary, not revolutionary, that we have taken it another step. And I think it's important for the strategic community in Washington to talk about whether that's the right policy for the United States. Do we really want to go down this path of strategic, branding China a strategic competitor, and then if you follow up with the defense strategy, having defeating and deterring our rivals, i.e. Russia and China, is where we should be spending most of our money on defense as opposed to on a lot of other things. And I think that does, your question is right, that does permeate. And I think President Xi has basically said, we're still open, we're welcoming, we'll defend ourselves, though, that this is, we're not going to provoke anything, but if the United States wants to come and be confrontational, we're prepared to respond. This woman in the back, in the brown coat, yeah?
Thank you. I'm John Chi with Taixing Media. My question is on the 301 investigation, which is focused on Made in China 2025. That's an industry policy to encourage innovation, but I think U.S. also had this kind of policies such as Manufacturing USA, which is put forward by Obama. So I'm wondering where is the U.S. view of the boundary of government and markets in encouraging innovation, and also this round of tariff. Where do you see this going? Will it eventually be solved by bilateral negotiations? Thank you.
Thank you.
Everybody's looking at you, Al.
I'll take a stab at that. It's a very good question, and I think in my mind, it goes to the point I was making a little while ago about the importance for both of our countries to understand that we operate very different economic systems, and therefore we need to work even harder to understand each other. To be sure, in the United States, political leaders and others will talk about national goals, economic competitiveness, and things like that. And there is a tradition in the United States of having government involve itself in basic research. Usually the United States tries to separate government from the commercialization of that research. Now, yeah, I'm saying usually, I didn't say always, but that is the fundamental principle, and I've been in a lot of cabinet meetings where we talked about exactly trying to make that distinction. And I think that it's important in China to understand that the fact that the 2025 strategy is seen not just as a statement of aspirations, but also as a statement of policy, is something that needs to be taken seriously in working with the United States. Having said that, I don't subscribe to the view that every Chinese government, every Chinese investment in the fields identified in 2025, even if it's supported by government capital, is a threat to the national security of the United States. And that's why I think that it is very important for there to be an intellectual distinction in the minds of American policymakers between those things that we think of as being an unfair competitive advantage in emerging industries of great importance to each country and to the world. On the one hand, from activities or investments or acquisitions that could be a threat to national security. And we need to be very clear-minded in talking to each other. We need to be very sophisticated in working through those problems and reaching general understandings. You asked about how the 301 process ends up, and obviously I don't know, and I'm not going to make any predictions. I think there is a cliche that happens to be true, that a crisis is something that has both danger and opportunity. And I think it will be incumbent on the leaders of both of our countries to work hard to seize the opportunities to correct some longstanding difficulties, not in totality, because life doesn't work that way, but to make significant down payment on eliminating some of the tensions and problems that have troubled the relationship in the past, and then moving forward. If they do that, then I think the crisis over the 301 dispute could end up being an opportunity for both countries.
Right here.
I'm Tom Duesterberg of the Hudson Institute. I have a sort of a methodological question for the Rhodium Group. Your data has become the definitive data on Chinese investments and U.S. investments in China. So my question is on, you have asserted a very remarkable shift in the ownership structure of investments in the United States from overwhelmingly state-owned enterprises to, you say 91%, I think, this past year was in private firms. As you know, Thilo, some of your other work with Merrick's, for instance, has shown that there's sort of a murky line between private enterprises and state-owned enterprises, and the WTO, the TPP agreement are all grappling with the question of how to define an SOE. So my question is really, how confident are you that this figure of 71% of flows are now in the private sector over time? Is that, Are you comfortable that that's really accurate and takes into account other factors such as state-directed or opaque types of ownership?
So I can ask you for the mic. The answer is yes, we're 100% confident that we're capturing those numbers based on the criteria that we apply, right? So, and if you look at the methodology, which is in the back, what we define as state-owned is that ultimately the Chinese government or any Chinese government entity owns at least 20% of an investor. That's what we define as state-owned, and the rest is private. And what I'm confident in is that we get that right in terms of tracking the ownership structures. When you ask me whether this accurately captures government influence, the answer is no, and I've said that in many places. And I think the last time I got that question was with the U.S. China Commission at a hearing. Certainly, if we're getting to that point, asking whether the Chinese government still has influence about those privately owned companies, the answer is in a system that does not have the same type of rule of law. The answer is yes, certainly, and recent tendencies with a greater role of the party certainly reinforce those concerns. But yeah, in terms of the methodology, we still find it a useful category analytically to look at that distinction, private-owned versus state-owned, based on pure formal ownership structures.
Over here, this gentleman, right on the corner.
Thanks, Stephen. Zhenghua Lu, South China Morning Post of Hong Kong. I have two questions. The first is I want panelists to share your views on U.S. Congress' role in this looming trade war, because the U.S. Congress did intervene when the Trump administration wants to impose steel and tariff on most of its allies, and those allies got exemptions. So would you expect the U.S. Congress to intervene into this U.S.-China looming trade wars, and at which stage? Second is about China's retaliatory measures. A former Chinese diplomat to the U.S. said yesterday in D.C. that Beijing can raise the proposed 25% tariffs to 50% tariffs. To avoid some speculation that Beijing was running out of countermeasures to the Trump administration's actions. Do you see that there is a problem for Beijing for collecting pile up those countermeasures, and what kind of other measures they would take? Thanks.
I'll start. Just on the question of the role of Congress, I mean, it's interesting, of course, that members came back from Easter recess to this looming trade war, and one of the first things that Ways and Means did was say we're going to have a hearing on the impact of tariffs on the U.S. economy. Clearly, there are members of Congress, and I think across both parties, who look at this in terms of how the midterm elections will go in the United States. And so I think that there have been some pretty forceful statements coming out of Capitol Hill in along the lines of the business community, also saying tariffs could be really damaging to the United States, and so isn't the effective tool to use in dealing with very real concerns about an imbalance in U.S.-China trade. So I think we're going to continue to see that, the role of Congress trying to, on behalf of their constituents, farmers and manufacturers across the United States, again, raise an alarm bell that tariffs aren't likely the way to deal with the very, very significant concerns the 301 report laid out. How effective Congress will be, I think, remains to be seen. But again, in terms of the midterm elections, and many of you in this room are, I'm sure, seeing this as well, our clients are American companies who are looking at the rhetoric from Beijing and Washington, D.C., are saying, wait a minute, we are getting off course here in trying to actually deal with a problem, and tariffs aren't going to deal with the very real challenges that exist.
Okay, here's a number 2 question from China Daily. Charlene is China Daily. This question is for Dan and Thilo. What will be the impact on the Chinese investment in the manufacturing sector if the tariffs are to occur on both sides? Because your research shows that more and more private companies, especially in the manufacturing sector, they came to United States, set up their own factories. I assume many of them import their raw materials from China, and many of them export their product to China as well. I interviewed the president of Wanxiang America. He said that they acquired A123 system in 2013 with a big number. He said that 70% of the batteries they produce now export to China. So if the tariffs are to occur on both the raw materials and their product, what will be the impact on them? I guess many of them now are in fear of what will happen to them. And what do you think? How do they need to cope with the situation? Thank you.
Let me just say, because this is a general question that we're getting in many different ways from our clients, from press, from fellow economists and policymakers as well. And the general answer to your specific question is that really nobody can say with any confidence that they understand the full likely impacts of this kind of hasty disruption in the U.S. China bilateral economic relationship, which is going to affect and be affected by lots of other bilateral relationships out there in the world as well. So nobody really knows exactly what the welfare impacts are going to be. They're going to be significant. They're going to be they're going to happen in places we didn't expect. They're going to be probably more damaging in China ultimately than in the United States, because the U.S. has mature market mechanisms to make the adjustments to these kinds of changes, whereas in China it will be done by state planners who are more likely to bring politics as their tool rather than market mechanisms as the tool. But on both sides, it would be really, really damaging to our firms, to our individual welfares, and to our confidence about what kind of world we're trying to build going forward, right? What's the alternative to the kind of presumption of globalization that we've worked with together for 4 decades almost here? All of that said, nobody can take it for granted that because the costs are so high, therefore an advanced economy is never going to push the stop button on globalization. I think what we've learned, right, in this moment is that even though a certain course of action could be very irrational from a economist preferred perspective, economists aren't the only ones who rule the world, not even in Washington, the United States, or maybe especially not, for better or worse. And, people are going to make choices based on more than just their rational interest. It's always been true in human history, and it's true today. And unfortunately, we're putting this to the test today, that long-standing concerns about fairness and reciprocity, not just in the United States, but in other nations as well, that were not addressed, were left to fester, and now they're causing politicians and others to do irrational things from my perspective, but, things that people do. And so, yeah.
Back here, in the white jacket.
Thank you for doing the panel. It has been wonderful. I'm Yo-Yo from Hong Kong Phoenix TV. My question is, with all the developments in the past couple of weeks, what kind of recommendations can you make to the Chinese side and to the U.S. side to mitigate the risks of a trade war, a full-scale trade war? Thank you.
I might take a quick stab at that. I think it's really important for both sides to keep in mind First of all, as Dan and I think I said as well, that there are real problems to be addressed, that we need to be clear-eyed and very adult and grown-up and sophisticated about dealing with them. At the same time, I think that we also need to be sophisticated in realizing, as Amy said, that tariffs and trade wars don't solve problems. They're the signal that problems have not been successfully addressed. Third, I think it's important to really be attentive to the guardrails that need to be in a relationship, the thing that makes sure that your cars don't go off the road and into the ditch. And part of that is the relationship that the two presidents have established between themselves and the importance that they have in working together on other issues. I mean, there happens to be a shared concern about North Korea right now as well. There are shared concerns about terrorism. They need to keep in mind those guardrails. There are guardrails in the U.S. system, the congressional pressures. There are guardrails in terms of the business community, which on the one hand, many businesses are very concerned that they don't feel as welcome in China as they did in the past, and we heard a bit about that. At the same time, businesses realize more acutely than almost anyone that massive disruptions and massive tariffs aren't the solution. They're the signal that the solution hasn't been found. So my rather platitudinous advice is that the governments need to really focus on the real problems and trying to resolve them. They need to be clear-eyed and honest with each other, and they need to stay within the guardrails that have been established.
Right here, and then we're going to.
Thank you very much. Dong Huiyu with China Review News Agency of Hong Kong. And you talked a lot about the limits that are imposed by both sides, but I would like you to elaborate the major reason behind the limits. That is, I think it is the increasing strategic competition between the two countries. And my question is, are you more pessimistic or optimistic about the long-term perspective of the mutual trade and investment between the two countries? Do you see any trend or tendency of the, disconnection or discoupling between the two countries? Because in the past, we always said that the economic interdependence between the U.S. and China is the basic cornerstone stabilizing the U.S.-China relations. So do you see any trend of this kinds of disconnection or discoupling? Thank you very much.
Volunteer?
Yeah, sure, I'll go first. I guess the way I would address your question is that long-term versus short-term, right? This is a moment in time in terms of the discussion and what's happening between the two governments right now and the implications of that. But long-term, the two economies are very interrelated and interdependent, and I think my view would be that is likely to increase over the longer term because it's going to be driven by the needs of the two economies. Now, recognizing very different systems, very different potential objectives, but if you get back to what drove a lot of the investment in even the period over 2016, it was that interdependence and recognition that the business community can drive a lot of that interdependence for the benefit of both economies. So I do think that once we get past this particular moment in time, the long-term trend is going to be very positive for both.
I'm deeply concerned in the short term of what's going to happen. I mean, I think there are a lot of proposals floating out there which would be extremely damaging to the United States itself, to U.S. China relations, and to China. So my short-term concern is as high as it's been in the last 30 years. So I am deeply, deeply concerned. In the long term, it's the people of the United States and the people of China that are going to determine what the relationship is about. And the favorability among young people in China in their view of the United States in their view of China is increasingly positive. We have 350,000 students, Chinese students in the United States. We have 25,000 American students in China. Hopefully that's going to grow. But in the end, that is what's going to determine the relationship. And even if we go through the short-term disruption in trade and investment, potentially even in visas for Chinese students, which I think would be a destructive decision for the United States, forget U.S. China relations. In the end, we'll get through it, and the fundamental views of the American people and the Chinese people are going to determine the future of the relationship. So when I look out over the horizon, you know, I see that it will be okay, but that doesn't make me sanguine about what is going to occur over the next 12, 18, 24 months. It may be deeply, deeply disruptive. And I think if it's disruptive, you just need to find ways to get through it, make sure it doesn't injure the fundamental relationship between the United States and China. And we haven't touched today on I guess Al mentioned North Korea briefly, but that's obviously incredibly important. We haven't talked about Taiwan. We haven't talked about the one China policy. We haven't talked about a lot of things that can disrupt the relationship much more seriously than this tit-for-tat trade threats and investment threats. And that for somebody who's worked on the relationship for 40 years, and was, as I kicked off the program and said, was there when we established diplomatic relations with China and worked on the creation of the one China policy. Those are deeply disturbing and just means we need to educate and understand what underpins the U.S. China relationship, why we made those decisions over the last 40 years and why we've had peace and prosperity in the Pacific. There are a few people in this room who were around during the war in Vietnam, and we remember what Asia was like then, but all of you have been around as we've watched Asia since the war in Vietnam, you know, be peaceful and prosperous, and to undermine that policy to me is a deeply disturbing and concerning action. But I think in the end, it's the people that are going to decide it, and I think the people actually know at times more than what the leadership does. I think we need to close this. I want to thank Covington for giving us this fabulous venue, and again, this wonderful day. And, you know, thank Dan and Steve and Al and Amy and Ken for a terrific panel. And thank you all for coming.